Hi, I'm Kata Gruneberg, CPA and Masters of Accountancy graduate of the University of Wisconsin-Madison. I'd like to welcome you to the SBDC Entrepreneurial How-To video series. Today, I'm going to give you an overview of cash flow management and how understanding cash fluctuations can impact business decisions. Cash is critical when it comes to operating a business. Cash flow reflects the cash inflows and cash outflows in your business over a period of time. Projecting your cash flow is very important if your business is impacted by seasonal fluctuations in sales, if you carry large inventories, or you sell on credit. When preparing your cash flow forecast for a new business, it is important to review industry standards so that you can identify patterns. If you're an established business, you can refer to past records of sales and expenses. For example, if you own a tree trimming service, it's helpful to know how much cash is needed to pay bills when your sales and your cash receipts slow down during the winter months. The statement of cash flows is a financial statement that summarizes your cash inflows and your cash outflows. Inflows, or receipts, can come in the form of sales, loans, and investments. Outflows, or disbursements, can include the purchasing of inventory, cash spent on other operating costs, loan payments, taxes, and other cash outflows. When these numbers are compiled, a positive cash flow indicates that there is more money flowing into the business than going out of the business for the period of time that is being reported. A positive cash flow allows the company to use the cash to pay off debt, reinvest in the company, or save for future growth. A negative cash flow indicates that there is more money flowing out of the business than coming in. For example, it is possible for your business to be making a profit but have a negative cash outflow for certain periods of the business cycle. Say you own a tree service and you have to purchase trees for the upcoming planting season months in advance. You won't earn income from the sale of those goods for several months. The upfront purchase of inventory could cause a negative cash flow until those sales are made. In order to manage the company's cash position, you may need to have a line of credit or prepare with adequate savings. The cash flow statement is reviewed with the profit and loss statement and balance sheet to fully understand the financial picture of the business. To gain confidence in your ability to effectively manage your business's financial position, you may want to take a class on financial management and seek help from an accounting professional. Now that you know more about what a cash flow statement is and how it is used, check out the rest of the SBDC Entrepreneurial How-To video series to help you build your business.